So hi there and welcome back to my channel. We're going to continue the study that we started on seeing how different option strategies react to changes in the market, to changes in time, as well as changes in volatility. What we're not doing is we're not just putting on some trades and then observing how the price moves and saying, oh, this one lost, oh, this one made money. Obviously, that would happen when the price moves, but that's not what we're talking about. So what we're doing with these trades is we're observing the difference and the impact that volatility has on the trades, that your price changes have on the trades, and the impact that Theta has on the trades. And what we're going to find out is the impact that Theta has is really very little. And unfortunately, a lot of traders are steered away from any trade that doesn't have Theta because they're making Theta as their number one priority whenever they construct a trade or when they trade a portfolio. So let's look at some of the facts and some of the statistics. If you look around the internet, you're going to see that it's estimated that over 90% of all option traders are consistently losing money. But then, if you look around the internet, you're also going to find out that probably 90% of the traders are selling premium. What are they doing? The iron condor, the credit spread, and naked puts cover calls. These are probably the most popular strategies of all time. So if 90% of the traders are losing their money and 90% of the traders are doing these strategies, well, it should be pretty obvious how these people are losing their money. So that being said, why don't we do something different than these 90% of traders are doing so that we can have a different outcome? Anyway, so I'm debunking the myth that Theta is really where all the money's coming from. Have you ever heard anyone getting rich overnight because of a Theta position? It's not going to happen. So in our study, it should start to become very clear that your Theta position, the impact of that Theta, is not nearly as strong as the impact of your Vega position or your other attributes that are impacted by price changes and as volatility changes. Let's look at our examples. These trades have been going on now for 28 days and they have 21 days left. And again, I haven't made any adjustments because I want to isolate these trade structures and compare them to each other without making adjustments so that we can see the embedded profits or losses or risk that's internal of each trade. So first, let's look at the price chart. So we're looking at SPX. We started this trade around January 26th. And since then, SPX has increased about 4%. Then if we move over to the VIX, we're going to see how the volatility's been changing. And what we see is that since January 26th, well, the VIX hasn't really changed. So obviously it's changed within that time, but take a look at the chart. So we went relatively sideways, went up slightly, and then it went down slightly, and then it spiked up a little bit on February 13th. Then it dropped back down, then it went up a little, and then the last few days it dropped. We're looking at things on February 23rd because I'm just finishing on a Friday and I was just analyzing these trades on various Fridays. So since the trade has started, really the VIX hasn't really changed much at all from start to finish. So let's take a look at this short unbalanced condor. The first thing I want to point out is that the Theta position is currently negative 700. So over the last 28 weeks, that would be an estimated loss of 19,600. So again, if you're an option trader, you're focusing on theta, you're thinking there's no way I'm ever going to do this particular trade because this tremendous negative theta is just going to be really detrimental to this position. Okay, so most traders will just be steered a different direction. So an estimated $19,600 would be lost because of the theta position. But now that we look at this trade after 28 days in, it's up $12,880, which actually represents a return of 63%. Think about that. So next we're going to look at a day-to-day performance of this unbalanced condor, so we can see how it really is correlating with price changes and those volatility changes. So if you look at this trade throughout the time, it's really gone kind of sideways. It started positive, it started up pretty well, but then it went down February 5th and 6th, and it was in the red, it was losing. Then it quickly jumped back into the positive, and you can see that it was a bit volatile. I mean, you're up, like, this is a chart of percent return, so you're bouncing between 30% returns all the way down to about 10% loss. So it's kind of swinging quickly between those two values, and then it drops down to about 23%, and then it jumps up over 70% in one day, and then it finished at 62%. So you can see that it's a bit volatile, but where's the theta really impacting the trade? You know, if you look at these, it's really being changed dramatically by the price changes and by these volatility changes. So next, let's take a look at the super famous Strangle strategy. So the Strangle here, the short Strangle, we're selling a put and we're selling a call. And this one, after the 28 days, is down 4,830, which represents about a 24% drawdown. You can see from the chart that you're actually still within the body of that spread, and the market hasn't moved up too much, right? It's only moved up 4% in the month. So this trade could not even handle a 4% move. And so it's currently down this amount. And then again, what's noteworthy is this trade has a theta now of 900 per day. So again, that's well over $20,000 in theta, and probably closer to about $26,000 to $27,000 in theta that this trade should have benefited from. But then you see that the trade has not made any of that money at all. So again, here we're witnessing that, you know, the price changes and these volatility shifts are much stronger than your $27,000 in theta that you could have made. So let's move on to the next. Okay, so here we're looking at that profit and loss chart of the Strangle through time, and we see it's very choppy. Again, where's that theta really working? I mean, you have the trades down 5%, it's up almost 40%, it's back down 15%, then it zigzags, then it hits about 25%, then it falls all the way down 35% down, and it finished so far 24% down. So again, if you're making all this theta, why doesn't it really appear on the chart? Well, you have to remember, when are you going to make that theta money? Well, that would only happen if the market is just frozen, right? So you have to go like a whole month where the price doesn't change and the volatility doesn't change at all, which would basically mean the market shut down for 30 days, and that's where you're going to make your theta. However, in reality, that doesn't happen. And so that's what we're seeing from these charts. Let's move on to the next trade. So now we're back at this calendar spread, and the calendar was doing really well, but you can see that now that the market's moved 4% total, and also the volatility went up, but then it went back down. Now the trade, although it's still working, isn't making nearly as much. So it's up about 5%. Still, it's better than losing money. Now this one again, you have a theta of 100 per day. And so after 28 days, that's close to the 3,000 points of theta. I mean, if you made any money, $3,000 from the theta position, but it's up 1,000. And again, if you look at the P&L chart daily, you're going to see it has really little to do with the theta whatsoever. The trade's quickly up 5-7%, 15, 20, hits about 30% real fast, gets almost to 35, then it starts to tank and it's back down to 4.74%. Again, where's all of your theta of the trade? You can see that it has very little impact, $100 per day in theta, but at one point it's up over 30% return, and not sure what the dollar amount would have been on that, but probably by looking at the margin of the trade, so it would be somewhere around $7,000 profit of this trade, but obviously that wasn't made from the $100 per day of theta. Again, just another example here where your trade, although it has some positive theta, there's no way it ever made 7,000 on the theta, and then it also wouldn't just lose all that money back because of the theta. All of your profits and losses on these trades, well, most of them are from the volatility shifts and from the price moves. And should be clear that theta, although somewhat important to your trade, it's not nearly as important as volatility and price shifts. So hopefully some of this education is starting to sink in and starts to open up your eyes, because there's other ways to trade than to just focus on your theta position. So just some final thoughts about these three different trades. Their attributes are a little bit different. So the short unbalanced Condor, when you look at the performance, it's really quite choppy. Although it was typically in the green for the trade almost the whole time. That's because the price was consistently trending up most of the time for SPX, and the volatility was slightly increasing and didn't decrease. And so that's really helped this unbalanced Condor to perform pretty well. But then when you move over to the Strangle, you'll see that looks like more than half the time the trade has been in the red. And again, it's because the price has been trending up and not going sideways, and the vols went up slightly. So that's where all that profit and loss came from. And then when you look at the calendar performance, it's actually probably the most consistent, because it only has 1 day in the red. And all the rest of the days, the trade was profitable and almost making money every day. And again, that's because the volatility was grinding up the entire time, and it was impacting the trade in a beneficial way. And so pretty much the whole time, the trade was just making much more than $100 per day that it would make from the theta. But then you can see at the end of the trade here that it really tanked, and that's when the vols dropped once again, when it came back down to that starting volatility level. And you can see how it wiped out over 30% of the returns in just 1 day with the drop. So that should be pretty eye-opening to you of how much volatility and price movements are really impacting all these option trades, and much more than theta. So I hope you guys are starting to learn some things from these videos, and don't forget to like, share, and subscribe, as everybody says, and I will catch you in the next video. Thanks.